So we're going to be covering some things today which are they're relevant to transfer pricing. I'm not giving you a transfer pricing session today. Two reasons for that. One, there's one a bit later on, and two, I'm definitely not the person to do that session. But we're touching on things where transfer pricing is of relevance. Is anyone here a transfer pricing specialist? There we have one. Excellent. Would you like to come out here and take the clicker? No. Well, it was worth a try. So some of the things I'm talking about, transfer pricing does kind of impinge on the things we're talking about, but we're not going into any of the methodology. We're just saying that it's there as a feature, and you'll see what I mean as we go through that. So we're talking really about where we have arrangements, which we've already touched on in some of the discussions we've had to date, where we have arrangements whereby we have intellectual property, or we have expertise, or we have services that are being provided from one entity in one jurisdiction to another, and ensuring that those are being provided at a level that is suitable and justifiable in terms of what you might pay to a third-party provider. So we will be touching on some things on that. So what we're going to be looking at today is we're going to be looking at a few structures through which businesses operate, and we're going to be in that context talking about things like mergers. I'm going to be covering something called an inversion and talking about some of the US rules on inversions, because there have been some developments on that, and talking about things like where you have the acquisition of a business from the point of view of the acquirer, what are the considerations, where you have the sale of a business from the point of view of the vendor, what are the tax considerations there. So this is a little bit more, in some ways, practical than some of the other sessions that we've been looking at. And we will be looking at some real life business structures and looking at how the tax rules apply to those, because international business has moved on dramatically in the last few years. The pace of change is ever growing. Supply chains don't look like they did if you rewind back 10, 15, 20 years. The way that businesses organise themselves looks entirely different. Interestingly to me as a tax expert, I'm not sure that most governments have really kept up with the pace of that change. I'm not sure the most tax systems really keep up with that. And that's an interesting point to bear in mind, because a lot of the BEPS actions, for example, in my opinion, are chasing some things that have already moved. So they're trying to tackle some things that they regard as kind of mischievous behaviour, whereas it isn't really mischievous behaviour, it's just a reflection of how the world really is and how businesses really operate. And I'll be explaining what I mean by that as we go through. Now, there's quite a lot of things I'll be covering in this session, so here they all are, and I promise not to do my normal, good morning, I promise not to do my normal agenda joke. But we will be talking about where one business acquires another. We'll be talking about before we get on to that, we're talking about different supply chain models and different ways that businesses might organise themselves and what the tax considerations are with that. But when we come on to looking at how businesses are acquired and sold, we will be touching on some of the options that are available to businesses in that context. So do you buy a business by buying the shares of the company that owns the business? Do you buy a business by buying the trade and assets? And what are the different considerations with that? And for that purpose, you do have to consider things like stamp duty, and you do have to consider things like VAT. I won't be going into any great detail on that, but I'll just be giving you some headline points on it. And the point is here that the principles, tax principles, are largely cross-border. You tend to get the same sorts of things applying in pretty much every country with regard to those taxes and how they impinge, how they affect the choice of structuring a sale or acquisition. We've touched on different tax planning regarding dividend, interest, royalties and fees. That will still be figuring in what we're talking about today. And I will be telling you a little bit about inversions, and in particular the US rules as they changed on trying to safeguard against inversions. Can anyone raise their hand if they know what I mean by an inversion? Nobody? Excellent. That means I can keep it as a lovely surprise for you when we get on to that section. And we'll be talking about participation exemptions that exist in most countries. These are exemptions from taxes on dividends received by corporates, and exemptions from taxes on sales by corporates of shares that they own in other corporates, and that's significant in the context of how you structure an acquisition or a reconstruction, or how you structure a sale. the ultimate effective tax rate you end up with in a company has a dramatic impact on what that company is worth to a potential buyer, and I'll just be giving you a couple of slides to illustrate that. I think we've got that one twice for some reason. I won't be doing stamp duty and indirect taxes twice. I'll do it once, if that's okay with you. We'll be talking about different tax planning that applies to the models that we're looking at. Obviously, the BEPS considerations will figure in that. Obviously, the lessons that we can learn from what the OECD commentary says about how some of the anti-BEPS rules are being applied figures in that. And we'll look at some of the practical implications of any of the planning that we are talking about. Is everybody happy with that, ladies and gentlemen? Yada, 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 yada. Okay, so what I'm talking about here is, over the next few slides, is how businesses in real life organise their affairs, which is different to how a traditional model might be. How things have really changed over the years and how practically businesses operate, which might not fit exactly with how the tax legislator, how the person writing the tax rules, what they had in mind when they wrote those tax rules. And we've already looked at one simple example, which I'll just run through again in a moment, just by way of reminder, and then we'll be just extending that into more complex things. But the point I would make is that on several of the slides, it may say things like, for tax reasons, somebody may look at reorganising their supply chain in this way. Well, yeah, okay, that's true. But that is a huge oversimplification. These are genuine commercial decisions that are made by large corporations to structure their business affairs in a way that fits with the 21st century world. And that isn't necessarily the model that it would look like in the 50s, 60s and 70s. Lots of people writing the tax law were brought up in the 60s and 70s, and some of them have still got that kind of model in their mind. That's genuinely my belief. And I remember that from working in the UK Treasury long time ago, but even then people were still referring to things that were long since past. And you do have this lag in tax rules catching up with the commercial world, and that in some ways is an opportunity. In some ways it's a threat, in some ways it's an opportunity. But you remember this. We've talked about this as being a tax planning technique, but I just want to make a point about it in terms of the real world. Do you remember what this is about, by the way, the commissioner arrangement? We've got a business in a low tax jurisdiction, and what they want to do is they want to use somebody in a high tax jurisdiction to basically sell their goods. So that person is over there, and he may be drawing up contracts on behalf of the country, on behalf of the principal there. What's the problem if he's drawing up contracts for the principal there? Thank you. That would be creating a PE in this country, so be creating a permanent establishment in that jurisdiction, and then you might have to look at what profit you would attribute to that PE, and that might be taxable in the highest tax jurisdiction, and that might have a tax cost. Okay, so to avoid that risk, what normally will be happening is we'll be trying to operate this in a way where this guy is just getting some kind of fee for going around and trying to find those clients, and it may be based on a proportion of the fees that are brought in from those clients. It doesn't really matter, but the point is that the risk with him is actually very, very low, isn't it? That guy just goes out, and if he has a good day and he wins a lot of business, he gets paid a lot more. What he doesn't do is he doesn't take on any of the risk. He doesn't spend a whole lot of money on buying a whole lot of stock or buying a whole lot of goods and then have to go and sell them on. And I'll be touching on the concept of a low risk distributor in a bit, and that's the same thought. The point is that the risk is staying with that country, that entity there, and they are therefore taking more of the profit. Now, we talked about all the tax advantages in that. We talked about the tax risks on that. We talked about the fact that that might create a PE, and you might be happy with it being a PE. You might not want it to be a PE, but you've got to be aware of all those tax risks. A fundamental point here is that lots of people will set up this arrangement ignoring tax. Why will they do that? Because they want the profit there, and they don't want this person to take a huge cut of what they're doing. They want to keep the risk and the ability to make most profit. That's a perfectly commercial decision. Do everyone see that? If instead you just sell your goods to somebody here who then goes and distributes them, they may make a huge turn on it. They may do brilliantly. They may lose money. They may lose money on it. They may sell them below, taking into account their costs as well, below what the total cost of acquiring those goods and selling them is. So they are taking the risk. but they're also taking the possibility of higher profit. The commissionaire arrangement leaves the risk and the profit there. Everyone see that? It's nothing to do with tax. And although this is a tax course, so we're talking about this in terms of tax, be aware that most people will set up that arrangement without any tax motive whatsoever. We are talking about it in the context of tax for obvious reasons, but it's commercial. And in reality, the reality is that you've got changes in how companies operate, how corporations operate in terms of how they manage the supply chain, in terms of what they do, in terms of where they manufacture something, the contractual relationship they enter into with somebody doing the manufacturing, the contractual relationship they enter into with somebody doing the supplying. You've got changes in that over the years, and they're accelerating and businesses are operating differently. And as it says here, lots of companies have restructured their supply chain for tax reasons. Yeah, tax reasons do figure in them. In my experience, they tend to be secondary. They tend to be the second point in it. The first point is making sure the commercial thing works and making sure the biggest profit slice can remain with a principal company, can remain with the company that's driving the whole thing, somebody at the top of the chain. And as we know, where those things are, where those restructurings, where that choice of organising your business in that different way is getting you a tax advantage, yeah, all the BEPS actions are intended to negate or at least limit those tax advantages. And at the very least, yes, we do need to be aware of those actions, but the context in which we'll often be looking at the BEPS changes, at the legislation that's coming out in domestic law on the back of the BEPS changes, the context of that normally will be in the need to be aware of it because it could be applied to something that is basically commercially driven. But I've got to say, where something is basically commercially driven, the tax advantages, if there are any coming out of it, you can consider as serendipity, you can consider as just everything falling in the right way. And that's that's really in many ways the perfect scenario for doing the kind of tax planning that we want to do. And again, as I say, there is an element here of the tax rules, I think, and the thinking of taxing. Am I blocking your view, by the way, though? I do that. The thinking of taxing authorities lagging a bit behind the real world. Because look, this might be a sort of typical business model. You stop somebody in the street and ask them to imagine how a business operates, what the components of the business would be. If you ask them to imagine a big corporation and imagine all the different functions within that corporation, they might come up with something like this. They might think of this. They might think, well, the business is first of all developing something, isn't it? It's going out, it's got an idea, it's maybe developing a product, and it will pay some people to do research and development. So it's got this team of boffins sitting there developing this new product, this new idea, whatever it may be. It's got a whole load of people who are making the big decisions, who are managing the whole thing, who are running the whole process, who are making sure that the right strategic direction is taken, and they're the people who really provide the know-how and the business acumen, the business skills to make sure the whole thing can work. Maybe they've got technical knowledge, maybe they've got contacts, maybe they've got knowledge of how to get into the market or experience in that. Whatever it is, they're providing that know-how, that expertise. And I said traditional, that's actually normally my stick drawing of a factory. Everyone can see that's a factory, can't they? Because it's got that funny corrugated roof on it. There's a factory, there's your manufacturing function, and in a traditional model, that manufacturing function is there as well, and the business is using that manufacturing function to produce the goods. They come out the factory gate there, and then you've got a team of people out selling them, a sales desk in this example, so a trading desk. So that's a kind of classic model, isn't it? And all in one place in our example. Quite understandable. You'd imagine that they would all be in one place. And they may be part of a big group, and it may be there are lots of these little units around the world, all in different jurisdictions, but all in one blob. Yeah? Traditional sort of model, okay? But this is what you might do. You might decide that actually you don't want everything being in one place. You might separate out the functions, so you might operate in a way that's a little bit different. And again, this may be driven by wanting to split it off into the bits of the business that can really command a high profit and into the bits of a business which can't. So the bits of business which are functional and really which should be just covering their costs, maybe with a little bit of profit thrown in, but actually that you could outsource somewhere else for only a fraction of the profit that would otherwise be allocated to them when everything is in one place. So you might leave your R&D function in your high tax home country on the basis that, well, you can find loads of people to do the R&D. It's a well-trodden path. You need people with certain expertise, but there's lots of them about. That might be the view you take. It might not be, by the way. You might actually determine that that's where the profit is. You get the right R&D team, they can charge a fortune for doing what they do. But you might come to the view that you're happy that that's a relatively low profit margin. You might come to the view that the production side is relatively low profit margin. Yeah, you've got your own factory that does this stuff, but you can find another one somewhere else and you can pay them a few quid and they would do exactly the same stuff and just as well. Yeah? And you might decide that really where the value is, where the real risk and where the business either goes above the line profitable or below the line into loss is in these functions. It's the guys driving it, the people with all the ideas, the know-how, the contacts, the marketing experience, the business acumen, the business experience, the people driving it and making strategic decisions, the board, as we're calling them there, and the people doing the selling, the people actually getting into the market. Maybe this is quite low tech and that actually could be copied and you really don't think that's where the profit is, this is where the profit is. Yeah? Everyone happy with that? So you might, on that basis, decide that it's a good idea in our model where we've got that traditional model in lots of countries to actually stick all the people who've got the super expertise that we can really make money out of in one particular place. And yeah, there could be big tax savings from that, but that might not be the main driver. And we've talked all the way through so far about this being tax planning, but there may well be a perfectly good commercial reason why pulling all those people together when that table's got 50 people around it instead of whatever that is, 10, that you'll get synergies, that you'll get economies of scale, that you'll just get better operation, better communication, and the whole thing will work better. So you may decide on that basis that it's a really good idea to move all those people into one place and to have that board in one place, and likewise to have your sales function in one place. That's another reason why you might do it, and a genuine reason is, guess what? All these super fantastic executives and all these very bright people who are really driving where the business is going and who are coming up with the real decisions, they may actually prefer to be looking out over Lake Geneva rather than to be looking out over Preston. No offence, gentlemen. But who'd prefer Lake Geneva here? Yeah. Oh, come on, guys. Stick up for your hometown. Look, you know, I mean, defend the indefensible, you know. Yeah, everybody prefers Lake Geneva. And, you know, the attractiveness of a location is a factor that does genuinely come into this. And if you can have that in a low tax jurisdiction as well, then all the better. But can you see where you've got the ability not to just leave everything in one block and actually to decide to restructure a business where you can put all the different people from around the world who've got expertise into one place? Can you see that that can be commercially justifiable? I mean, I certainly can. And you know, and this is a trend in what lots of businesses are doing, and it's an example of what lots of businesses are doing, and it sort of reflects the principal model that I'm going to be describing to you in a bit. Again, driven by genuine commercial practice, not by tax considerations. Yeah, of course, what do? The finance director straight away, chief finance officer straight away wants to talk to the tax experts. When we do this, what does this mean? And of course we as tax experts all get very excited, but then we get very scared because you talk about all these massive opportunities and low tax rates. Oh my God, but what about PEs and what about everything else? What about transfer pricing? What about some of the other BEPS actions that might scupper us? Can we really rely on the provisions in the double tax treaties? We worry about all that. But remember that we just have to contextualise it. This is what businesses will do anyway. We as tax experts can just go and get other jobs. They'll be doing it in any case. And so I think that's the context in which you have to regard any potential challenge to any of these kind of arrangements. Everybody happy with that? Shall I just leave that picture up there for the rest of the course? Yeah, it's a little small actually, but... Okay, absolutely fine. And we are talking about, in doing that, we are talking about the risk and reward Well, in this case, if you go back to it, the bits where the risk is, let's say risk and reward, the bits that can really add the value, the bits where you can really charge for what you're doing at a premium compared to the bits where you can only charge at a basic level. What we're doing in a situation like that is, yes, we are transferring the risk and reward overseas, but yes, of course, there are tax issues with that, because in that example, the IP, all the skills, all that knowledge and everything is overseas, and therefore most of the profit, you'd imagine, would be coming in there. What does that mean for a transfer of intangible assets or intellectual property? And there you are getting into the transfer pricing rules. Or you might be getting into transfer pricing rules, you might be getting into other domestic rules that can tackle this kind of planning. So for example, in the UK, if a company goes overseas, if that company recognises assets on its balance sheet, it is treated at the point when it goes overseas as having sold and reacquired those assets. So you get a capital gain. Capital gains are charged at corporate income tax rates, so corporation tax rate still applies to that. So you get a tax charge in the company at that point. We have rules called transfer of assets abroad, which means that if you take IP and put it overseas, individuals doing that can be taxed on that just as if they still owned it in the UK. So you have to recognise the potential risk of those rules. All of those rules have strong commercial let-out, and the TP rules, transfer pricing rules, are really to do with what cost you're doing it at and how you're recognising that improper financial transactions going on between the related parties. So it doesn't mean you can't do it, it just means you have to be aware of it. We have to be aware, as we know, we went through this, did this to death yesterday, didn't we, about permanent establishments. All of you can spot a permanent establishment, I think. All of you will know when we might have a PE, and all of you will know the consequences of having a PE, which is at very least to dilute the tax benefits which we might otherwise get by getting all the profits going into a low tax jurisdiction, because you're going to have some profits attributable to that PE still taxed in the higher tax jurisdiction. Transfer pricing figures in this all the time. So if somebody was doing that, you would have to be alerting them to the risks of their tax authorities from the UK. The HMRC would be coming along, you'd expect, and asking how you determined the price at which you are paying for the services provided by those entities that remain in the UK. So how are you determining how much you're paying for your manufacturing? How are you determining how much you're paying for your R&D function? And if you have had any IP that's ended up there, how have you paid for that? And how are you recognising the use of that elsewhere in the business? So the transfer pricing position, you need strong documentation on that, where you're going to do this kind of arrangement, and you need good records to show that you have thought through those things. Don't forget as well, if you are advising anybody on doing a structure like this, or you're talking to anybody about a structure of doing this, there are costs in doing it. One thing is certain, there may not be a threat, there may not be a real threat, there may not be a realisable threat from some of the anti-avoidance rules that we talked about. It may be that nobody can stop you getting the tax benefits, but it's going to cost you something getting some specialists to actually advise on that, isn't it? So, you know, there's some cost in putting together this kind of thing. It's not that we're not saying that you can't do any of this because of rules that are being introduced by BEPS. We're not saying that that this is, you know, the anti-avoidance rules are reasons why you might not get the tax advantages, that the kind of basic tax advantages that you could start off identifying. We're not saying that that isn't something you should do. What we are saying is that you can expect the local tax authorities, so the tax authorities in the country where we started with that model, you can expect them to look at whether there has been the transfer of an intangible asset overseas, whether there has been something on which there could be a tax charge. You would expect that the cost at which any expertise being provided from the head office to other entities, and that it is charging for that, and where the profit is thereby coming into the entity overseas, you could expect that the price at which that's being charged is going to be investigated by taxing authorities. And you can expect to have to justify that all of these transactions are taking place at a justifiable market price that you can demonstrate is actually happening in the real world between comparable businesses, but where there's an arm's length transaction going on. So all I'm really saying on this slide is there are rules, as we know. Transfer pricing in particular is going to be something that will be effective in challenging the use of arrangements where you're splitting the supply chain and you're having different entities in different countries, but it's not a case that it stops it happening. It's a case that it means that you have to be in a position to justify what you're doing, and you have to respect whatever the local rules on that are. So if there is a requirement to have a country by country report showing how you've come to your transfer pricing decisions, that's what you need to do. If there's a requirement to get an advance agreement from any taxing authority, then that's something that you have to do. So it's just really that you have to be aware that transfer pricing is going to be an issue on any arrangement like that. Everybody happy with that so far? All we're talking about there is we're talking about a simple arrangement whereby we've gone from a traditional model of lots of functions in one place, in one particular country, to splitting those functions over different countries. And we just use a really simplified model there, not a particularly realistic model, but a simplified model where we're moving the board, the executives, the people really, the movers and shakers, the ones actually making the decisions about the business overseas, and we move the trading desk overseas into lower tax jurisdictions where they do better, but we've done it for commercial reasons. That's all that's about. Everyone happy with that so far? Everybody ready for this slide? There's a big slide. I'll give you a moment. Can everyone see that, by the way? I don't know how you're doing at the back, but it's blimey, I can't read it here. But these things, it says call-off orders and toll provision of manufacturing services. So I'll talk you through this so that you understand what all this is about. This is the principal model. This is a realistic business structure used by entities that might be doing lots of things. They might be, imagine an entity that to the man in the street, they think of it as being something that designs, develops, builds and sells a particular product. Okay, so it's a particular high-tech product and it's high margin product. There's a lot of development goes into it. There's an awful lot of cost goes into building it, and it's sold all over the world. Yeah, imagine that. Okay. This might be the way in which a business looking like that would structure itself, again, for perfectly commercial reasons. That, to the man in the street, that's the business. It's whatever, PLC. And that's a business that everyone knows the name of it. But in reality, the way it may be structured is that this business may not own anything that produces the raw materials. It may not own any manufacturing capacity. It may not own any storage capacity. It may not employ anybody to go and sell the assets at all. You can do this in a different way. And the first thing on this is that the principal here will enter into a contract with the supplier of the raw materials, but not a contract where they're going to supply the raw materials to the principal. No, they're going to enter into a contract whereby the supplier of the raw materials supplies the raw materials under a contract, normally with a whole load of different delivery dates, normally where they're able to negotiate that in a way where they say, look, you deliver this much raw material over the next 3 years on these particular dates and we'll pay you now, or pay you at today's rate, and we'll get a discount for the volume that we're ordering, and we'll get a discount for the fact that we're committing to that over a 3-year period. Okay, so decent commercial arrangement. Those raw materials then are provided not to the principal, but to what's called a contract or toll manufacturing entity. Does everyone know what I mean by a toll manufacturer? Contract manufacturer? No? Okay, don't worry about it. You can think of it really as being, I mean, a toll manufacturer it's a term given to a manufacturer who's really just kind of letting themselves out as a manufacturer. They're providing their manufacturing facility to anybody who wants to come and use it. What they're not doing is they're not a traditional factory that's part of a business that designs, produces and then sells these goods. They're just saying, look, we're a manufacturing plant. Anybody, anywhere in the world, come to us, send us your raw materials, tell us what you want us to turn them into, we'll turn them into that. you pay as a fee, and then you come along and pick up your goods, right? Can you see the difference? They're not selling anything. They're never owning any goods. And so that's what we mean by a toll manufacturer or contract manufacturer. They're just providing the service of manufacturing. Yeah? So all they ever get, they never sell anything. They just sell a service. They never sell the product. They just sell the service. And they know that the raw materials are going to turn up here. They know how they need their production line set up in a particular way to produce the particular goods that these guys here have designed and that they know about. They've already got that set up. They just wait for the raw materials to come along, and then at these guys' order, they churn them out. Yep? And all they ever take is a fee for doing that. There's also an arrangement whereby we have a contract with the sales agents here. We also have an arrangement whereby the principal enters into an agreement with the sales agent. And the agreement looks like this. I've described it here as a flash sales contract. Does everyone know what I mean by a flash sales contract? That's like an ordinary sales contract, except much more extravagant. So a really flashy sales contract. Look at my sales contract, it's great. A flash sales contract is this. I'm off in a particular jurisdiction, and I've found a whole load of people who want to buy this product here. So you guys want to buy this product here, yeah? Okay. Yeah, you're going to offer me some money for that, yeah? Fantastic, we've done the deal, great, sold, it's yours. Except, and I've gone around and I found loads and loads of people who want to buy this, okay? And so I know that what I really need to do now is I need to go to the supplier here. You supplied me with that, thank you very much indeed. I need to go along to the supplier and say, right, I need several of these because I need to sell them on to the customers there. So I enter into that agreement, right, okay? But I turn up and we've never actually signed a contract, and these guys have gone a bit cold on the idea, and I'm left holding these. Now, since that's a jar of sweets, I'm perfectly happy with that. But if that were 10 million high-value products that I couldn't actually sell, I wouldn't be so happy with it, would it? I would have taken the risk, and I may be stuck with something that's no good. What if there's been a shift in the market? What if it's been overtaken by new technology? What if it's an iMac and somebody's told everyone they're rubbish and not to buy them? Then I'm stuck with it, aren't I? And I can't sell it. So instead, under a flash contract, what we agree is this. We agree that basically you will consign goods to me, so I know I've got them. I know I've got them. I know I can call on them. And those goods sit there. So I know they're in that warehouse just waiting for me to call them. But I never own them. You own them. You legally own the goods. So I can go along to these guys with confidence knowing I've got the goods. The moment they sign the contract, you transfer them to them out of that consignment. You kind of earmark them for their use. Does that make sense? Who's got the risk there? Is it me? No, it's not me anymore. I don't have any risk. Because when these guys go cold on me, I just go, well, I'll get on with my life. There you go, you got some sweets. So I don't take any risk there. That's what a flash contract is, and that's what the principal will enter into with the sales agent here. Does that make sense? I don't know if I've explained that properly, but that's broadly what it is. That means the sales agent here aren't taking any risks at all. They're going out and finding customers in the knowledge that they won't let down the customers because the goods are already there in that warehouse, having been manufactured under that contract that the principal has with that company, with that manufacturer. They are now sitting in that warehouse just waiting for the customers to come along and buy them. So all they've got to do is find the customers, agree the price, and they know they're there, and they don't take any risk. And if for whatever reason they're not there, if the principal's lied to me, you wouldn't do that to me, would you, Andrula? No, but if Andrula's lied to me and they're not actually there, not my problem, because I don't own them. And that's not me who they can chase for the goods. There's nothing the customer can chase me for. Andrula owns the goods, or her company does, and that's who they will chase for them. Make sense? Great, okay. So that's what that arrangement looks like. And the point about this is, okay, obvious question for you. Who's taking all the risk in this arrangement? The principal, absolutely. Hence the name, I guess. The principal's taking all this. Why are they just particularly generous, decent people who want to help everyone else in the world, and they don't like it when other people take the risk, and they think it's really unfair and they don't want to stress people out? Is that why they are doing that, ladies and gentlemen? No, why are they doing that then, ladies and gentlemen?
To get the profits.
Exactly, because with the risks go the rewards. And basically, they see it this way. Yes, they could have their own manufacturing plant. Yes, they could buy somebody that can actually, they could buy a quarry from which they can get the raw materials or whatever it is. Yes, they could have employed sales agents all the way along. All that is doing is diluting their profit, because actually some of the profit that they are earning from this really goes into those functions. And you can see that when you do an analysis of traditional businesses, because they're paying way more to their factory workers, they're paying way more to their agents, they're paying way more for different functions than they would do on a model like this. That's what it's about, yeah? So this is a commercially driven model. It is not something that is just for tax purposes. You'll notice I slipped in the word there, just for tax purposes. You know why I did that, don't you? The key point is this: the risk and reward for the principal increases. It's to do with making sure that whoever's running this business, the person behind it, the people right at the top of it, are actually getting the biggest possible reward for this, and they're keeping their costs down to a minimum. That's really what it's about. And for that reason, they will be contracting directly with the clients. So I didn't tell that exactly correctly. I talked about shaking hands on a deal. That will actually be on behalf of Andrula when I shake hands on that deal. She's actually contractually committed to it. So look, pick it up with her about these sweets you haven't got. Okay. The principal will be contracting directly. And look, in that diagram, you see there, that's all the money coming back into the principal. There's the contractual agreements they've got with the customer. That's the ultimate end game in this. The sales agent or distributor in the local countries, yeah, they work with them, but they're only paying them a margin. And the quid pro quo, the benefit for that from the point of view of the distributor is they're not taking on the risk. They're not on the hook for it. So they can just go, they can turn up in the morning thinking, yeah, we've got all these goods to sell, but if we don't sell them, hey, we don't have such a great day, but we don't go bankrupt, because they just go back. The principal in this buys, owns and sells the product. So they never part with the goods for anybody else to take a profit margin on them. So all of this is entirely commercial. So really, there is no reason why something like this should be offensive to tax authorities. You would imagine the only issue is where you put the principal, isn't it? And why you put the principal, where you're putting the principal. That's really all it's about. But that's down to, isn't it, competition between different jurisdictions about how they run their tax affairs. And if Holland happens to run its tax affairs in a way that encourages people to set up finance companies there, then guess what? People are going to set up finance companies there. If Ireland reduces its corporate tax rate to a particularly low rate to encourage manufacturing companies to come in and set up there, guess what? That's what will happen. You have international competition rules about that, and there's one thing which I'm going to mention to you right at the end which might stop that happening. But really, if that's commercially driven, that's up to businesses to do it in the way they want to do it. But the big threat is that you can't prove when you're doing that all the transactions were done on a basis that matches an arm's length real life transaction, because these weren't arm's length real life transactions. They were all driven by the principal, and the principal could have retained its own manufacturing function, etc., etc. So you've got to have good, robust transfer pricing documentation. And I'm saying important to ensure no PE arises in the different countries. It's not quite right. It's important to understand what it means if you have a PE in the different countries. It might be that you've got a PE in a country, but actually the tax rate ain't so bad, so you're reasonably happy for that to be the case. It may be that you've got a PE in a higher tax country, in which case that's a bit more of an issue. But to the extent you can stop there being a PE, you'd imagine that most people would. And just a quick one for you, to stop those sales agents creating a PE, can anybody tell me what we want, what features we want there? To stop it being a PE, stop any of the sales agents creating a PE? Yeah, independent. They'll be running around, they'll be doing business for us, they'll be having contracts with other people as well. So we'll be one of the several clients they operate for, so they operate independently. Anything else? We don't want them to conclude contracts on our behalf, do we? They can if they're independent, oddly enough, but if they're dependent and they conclude contracts on our behalf and they habitually do that, then that's something that could make it a PE. So actually, the way it would be working is you as sales agent would be making the introductions. to the principal, and the principal would then actually sign the contract. They would conclude the contract. You would never conclude the contract. And remember, as we described it, that was actually what was happening. From the point of view of the toll manufacturer, let's take them. As we say, they've got very little risk and reward. You've got to think about the same sort of tax risks from their point of view, and you've got to check that these work. But from their point of view, the deal is de-risking their business, but I'm afraid at the same time taking out most of the profit that they might otherwise make or might otherwise be attributable to that business. All they're going to be taking is a margin for their services. You use our production facilities for 6 weeks to produce that many goods, you're selling them on for X million, we'll charge you 3% of that. That's how it works. Normally more than that. And the point here, it follows the principle that happens in transfer pricing. Remember, the more risk that you are taking for something, the more you can charge for it. And when you're looking at your transfer pricing comparables and you're looking at what will be a reasonable price for what you're paying, if it's for a low risk activity, then you don't need to be paying as much as if it's for a high risk activity. So what we are paying in terms of margin to the toll manufacturer, what we are paying in terms of margin to the distribution centre or the low risk distributor or to the warehousing part of this supply chain is going to be relatively low and justifiably relatively low. And the same kind of considerations apply if we had in that supply chain something that I'm calling a low risk distributor. Do you know what I mean by a low risk distributor? Anybody care to offer me an explanation of what I mean by that? What's a distributor doing?
Selling the product.
Yeah, selling the products, okay?
Low distributor that is taking the lowest risk instead of the product.
Yeah. And can you give an example of how practically that might be accommodated, how practically that risk might be low for a low risk distributor? Yeah, the direct contract will be with the customer, with the principal and the end customer. And things like, if goods are handed over to the low risk distributor, if they don't sell them, they're not forced to buy them. So the low risk distributor might be taking physical ownership of the product, but they're not taking legal ownership of the product. And you might even translate into that as well things to eliminate currency risk. So if you think of a high risk distributor, what a high risk distributor does is this. I hear that Andrula's got this fantastic product and I think I can sell it in my home country. So what I do is I go along to Andrula and I negotiate with her and I buy a whole load of this product. And I've got it here, haha, fantastic, I can sell this for millions. Then the market changes, then the currency rates change, and actually where I was going to sell it, I'm not making millions at all, I'm making a tiny margin, I'm losing money, disaster. That means I've got all the risk, doesn't it? You can take all that risk out by effectively me just being given the product, as I sell it at a particular rate, I take a margin on that sale, that's it. Yeah? Okay. Good. And I think when you come to look at the transfer pricing considerations on a model like that, what you're really trying to think is, what situation would we have if you didn't have that supply chain model? If you didn't have the toll manufacturer there and you didn't have that available as a function, what would you be doing and how much would that be costing you? We need to imagine that any participant in the supply chain, what could they ask for as a reward, as a payment for this, in a completely open third-party situation? So what could the sales agent really demand in the market, given their knowledge of the local market, given who they can get into, given what the likely outcome would be? What could they actually demand? And that's what the transfer pricing work will be there to determine. And you need to look at the model you need to look at it really before and after. So if you imagine it before and imagine what the total profit of the whole thing was and how you would allocate it to each of the different elements, and that won't be the most efficient thing because you'll have some that's being wasted, but you look at it afterwards and you can see the difference that you'll have made on that. It's a case of justifying that difference. So looking at it before and after will be one way in which you're getting to the point where you are determining what a proper transfer pricing model and a proper transfer pricing defence of this would be. And similarly, you're identifying any things that are genuine transactions along the way. So if you are transferring some IP from one entity to another entity and you're doing that at a price, or you're doing that under an arrangement where it's paid for over time, or you're using that IP where you're licensing it back to somebody, you need to look at all those transactions and make sure that you've got sufficient documentation behind it and sufficient justification for the way in which you've recognised it. Okay. Anybody looking at doing something like this, anybody looking at using the principal model that I've talked about there, will need to think about what it's going to cost to do all that, because remember, they've got, in my little example here, they're starting off with the traditional model where everything is in one entity, it's in one blob, as I put it, and what they're doing now is they're moving to this new model. Well, how much is all that going to cost? They've got to negotiate contracts with different people, they've got to find the people who are going to supply the raw materials, and they've got to find the toll manufacturer, and they've got to find the agents who are going to enter into those flash contracts that I talked about. And when you've set all that up, you've got ongoing compliance costs with all that. So you've got to factor those in before you know what this is really doing for you. The biggest one, but to my mind, the easiest one, is what's the commercial rationale of doing it. And the point I would make is that when you see a structure like that, yeah, somebody may describe that as being a great tax-saving structure compared with something just in a high-tax country. But actually, that is driven by how business really works in the modern world. And it's really driven commercially. And that's changing fast as well. You'll see new developments on different models and different ways of working coming in all the time that, as far as I can see, are always one step ahead of the tax changes. Okay, I've got a little case study for you. Your colleague asks you to evaluate the opportunities and risks of implementing a principal model within your European business. Your model will involve limited risk distributors of crude oil and refined product in each country, plus service companies in strategic locations providing certain management and administrative functions. What feedback will you provide your colleague? So your model will involve, so what we've got is, there's the borderline, and you've got different countries over here. So you've got limited risk distributors. Plus service companies. So it'll look like that in every jurisdiction, okay? And we've got the principal company here. And this is a low tax jurisdiction. Okay? So we're setting up that model. What are our considerations? Just throw me out some comments, ladies and gentlemen. Anything at all. These are higher tax areas. What are we going to be asking? What are we going to be saying to our colleague? What's the first question to your colleague?
What is the rationale of this?
Yeah, why are we doing it? Why are we doing that? And if the answer that comes back is, well, there's low tax rates here than in these places, and at the moment we're in danger of getting PEs in those jurisdictions because of the way we operate. Fine, that might still be okay. But what's the rationale? And the rationale, you would imagine, that is we've got these functions here at the moment, or we've got them somewhere, but they're costing us a lot of money. And you'd imagine that would be the commercial rationale. And actually we can operate through separate distributors rather than doing that work ourselves, and rather than doing that through something that we own. So it might be a subsidiary that's in this company at the moment. So that would be the rationale. Yeah, completely agreed. First thing is, why are you doing it? What's the next thing? Yeah, exactly. Yeah, what's it going to cost you to do that? What's it going to? You're doing cost benefit analysis, aren't you? If you're going to do something like that, you're looking at why you're doing it, what the cost is of doing it. In lots of ways, the fees cost, the cost in terms of time and management time that's going to be required to do that. What else are we then worried about? These are higher tax jurisdictions. Let's say we've already got subsidiaries over there that have been undertaking this and that have been taxed in those jurisdictions at the moment. What are we worried that these may be? Because we're thinking we're getting a tax advantage by getting all the profit back here. But what might these be? They may be PEs, yeah, exactly. And as we've seen, the service companies may be PEs as well, because under the UN Model Treaty, there's a description there about a PE can be something that is a service. There's a company providing services, bless you. So providing services into these jurisdictions, even if those companies are there, the providing services into those jurisdictions might fall within the definition of PE. You might have a PE, you might still have some profit attributable to entities overseas. Okay, that's it. That's all. We won't spend any more time on that because we've got quite a lot to get through, and that's only so valuable. Does everyone know what I mean by stamp duty, land tax? Okay, stamp duty is actually a tax on documents. I don't know if you know this, but in the UK, what you're paying for when you pay stamp duty is the right to be able to present the documents relating to that transaction in court. That's what you're actually paying for. So if I buy a property from somebody, the documents need to be stamped, then they are presentable to an English court. Without a stamp, they're not. So they can't provide evidence. So that's actually what you're paying for, technically, when you pay stamp duty. Stamp duty is a very, very old tax. So yeah, I mean, in some jurisdictions it's referred to as transfer tax. And very broadly, you get stamp duty you get stamp duty when you buy shares, and it's on the buyer, and you get stamp duty land tax when you buy property. And basically, when you buy shares, there's a very low rate of tax, and when you buy property, there's a high rate of tax. Stamp duty land tax in the UK now are punitive for residential property. Does anyone know what the top rate of stamp duty land tax is for a residential property in the UK? Correct. It is 15%, and traditionally that was no more than 4%, and it's now 15%. That's where a company, you ahead of me. That's where a company buys a residential property in the UK. We're talking about commercial property in these examples, so 5% is the top rate that's going to be applicable to a commercial property. And where things go around companies in the same group, generally there is an exemption from that, and there's an exemption on certain transactions where you do share-for-share transactions as well. Too many words on this slide, I'm afraid, but I'll just talk you through this very simply. This is talking about VAT. You know all about VAT. The way VAT works is it's very, very odd. If I'm providing services, I charge my services to my customer. My customer then actually pays the VAT in paying me. They don't pay it to the taxing authority, but they pay VAT because I don't charge 100, I charge 120. So I charge 120, I then receive 120. I haven't really received 120. I've received 100 with 20 that I owe to the taxman. That's how VAT works. Cross-border, it works a little more in a slightly more complex way. So if I'm importing some goods from overseas, I might have to pay the VAT and pay that over to the taxman, or I might be charged the VAT by the person importing it and they pay the taxman. Or in the UK, you have a reverse charge structure, which means that normally the person importing the good in the UK will pay the VAT and then claim it back. I don't want to go into it in too much detail, but you just be aware of stamp taxes and VAT as we're going through these examples, okay? And I want to talk about this situation. I want to talk about a situation where you've got this company that want to acquire this company. They want to merge. They see themselves as being potentially a great group together, so that company decides it wants to acquire that company. Now, in reality, and we'll see this when we're looking at the inversion thing that I'm going to be talking about, in reality that's oversimplified because it's talking about acquiring group, acquiring merger target. 9 times out of 10 you'd do this. You'd set up a special vehicle, you'd set up a new company, so we'll call that special purpose vehicle, SPV. That would be above the acquiring group, typically, and that would also acquire the merger target. So you'd end up with something that looks like that. And then all the people that were shareholders in here would become shareholders in there. Okay, so that might in reality be the structure that you're looking at, but it doesn't really matter for this purpose. It could be any way around. So let's just assume that the acquiring group are just simply acquiring the merger target. Okay, what do we got? Well, if it just acquires the shares, which is what we're talking about here, then we get stamp duty on the acquisition of the shares. Yeah, but it'd be a low rate, wouldn't it? In the UK, that's only 0.5%. And generally, most jurisdictions have a similar kind of reflection that stamp taxes on the acquisition of shares are generally a little lower than the acquisition of property. Now, believe it or not, under UK tax, that can be the supply of a business. Under UK tax, where you're dealing in shares, that's actually outside the scope of UK VAT, and you'll probably find you've got the same thing that's happening in most other jurisdictions as well. Anything that's a liability in there is going to be a liability in there, isn't it? So if there's a whopping great claim waiting around the corner to be made against merger target, that's still going to be there when we acquire it. Why? Because we are acquiring legally the company, and the company is a legal entity, and by acquiring the company we get all its assets and all its liabilities, unless we've actually separated out some of those, and we will have warranties and indemnities that will mean that the vendor will be on the hook for any liabilities that come out of the woodwork that we don't know about and we're hit for. That's absolutely fine, but warranties and indemnities are only as good as the person signing up to the warranties and indemnities, aren't they? You can have that covered as well in real life by things like retentions from the sale proceeds that are being paid over, but that's a bit harder because generally the shareholders want to be paid now and not sometime in the future if it turns out there's no liability in the next 6 years. But the warranties and indemnities are always a big part of these. You'd have to ask yourself, there's the acquiring group, and we've just got one box, the acquiring group. The acquiring group won't look like that, will it? The acquiring group almost certainly will look something like this. There'll be all sorts of stuff. It might look like this. And these may be in foreign jurisdictions. So you've got to think which company in the acquiring group acquires that merger target, because it could be there. We could have a special purpose vehicle at the top. It could be that subsidiary, it could be that sub-subsidiary. It can be anything you like, can't it? Does it matter? Well, it matters because the tax regime they're going to end up in, so that does matter. From the point of view of the purchaser, does it really matter which of these is doing the acquiring? Are they that bothered? Probably not. They're probably on the whole going to have some flexibility in which of those companies in the group acquires it, so you need to think about that. And when you're doing that, you will work out the effective tax rate that is going to apply to that company, and that will affect, I think, that will affect the price you're paying for it, because that will affect the value to you of that company over a number of years, which is normally how you're valuing a company that you're buying. And then you've got to think about how you actually come out of it in the end. Okay, so all those will be considerations. So that's number one if we buy the shares. What's the other? I've gone ahead. What's the other alternative? I've given it to you now. The other alternative is we don't buy the shares in the company. Instead, we don't buy anything from the company at all. We don't buy anything from the shareholders at all. The shareholders don't sell us anything. The company sells us something. The company, we enter into a contract with the company whereby we acquire from the company the trade and assets of the target. What's the big commercial difference with acquiring trade and assets? Forget tax. You know nothing about tax. Easier for some of us than others. But pretend you know nothing about tax. What's the big commercial difference in buying trade and assets compared to buying company? Exactly, yeah. Generally it's much lower risk because you can cherry pick the assets that you want. And if you buy a building from this, or you buy some intellectual property, unless there's a liability or a charge actually attaching to that particular asset, which is pretty unlikely and normally something which you can identify in the case of a legal charge, unless that's the case, it's liability free. Where you buy the company, you don't know what's hiding under the floorboards, you don't know what's hiding in the cupboards, you don't know what's happened in the past. That could be a liability that comes to bite you. You can never be really that sure, hence the complexity of the warranties and indemnities, but they're only so good. We won't get stamp duty on shares, will we? Do you know why? Because we're not buying shares. That's a good enough reason. Instead, we're buying assets. If one of those assets is property, then we'll probably have a higher stamp charge. You're unlikely to get a VAT charge on this. You will have a transfer of a business. Under UK law, if you have a transfer of a business as a going concern from one VAT registered entity to another VAT registered entity, then you're actually outside scope. So it's an exempt transfer, but you have to make sure both are VAT registered. And that's the big one. The liabilities don't follow. that only a liability for some reason, specifically attaching to a particular asset, will follow, but that's pretty unlikely. Still got the question of which of these companies in the group should acquire it. You've still got the question of what the effective tax rate is. And yeah, there may be one advantage you do sometimes get in structuring a merger in this way is that there can be tax incentives for the acquisition of particular assets. For example, you might be able, under different countries' rules, to buy an intangible asset and amortise that over a number of years and get a tax deduction for it. You might be able to. There might be assets that qualify for similar kind of amortisation reliefs like capital allowances. So there may be some advantages from a tax point of view in buying some of the assets of that. Make sense? Great. Okay, so they're the two big options you've got when we're looking at a merger or an acquisition from one company to another. And I will say a bit in a moment about what the tax rate, how the tax rate affects the value of that target when we get onto it. But I want to say a little bit about inversions. Does anyone know what I mean? I mentioned this earlier. Does anyone know what an inversion is? Okay. An inversion is a posh word for sort of doing an acquisition backwards. But you're doing an acquisition backwards because that changes the tax residence of your company. And this became big news in the US. And there's a particular deal that's referred to here, which is Pfizer and Allergen. So two whopping great pharma companies that were going to merge. I'll say merge. One was bigger than the other, so is it a takeover by one of the other? Well, academic really. What you're going to get is there's going to be one merged entity. The shareholders in Pfizer and the shareholders in Allergen are going to become shareholders in Pfizer Allergen, which we'll call it for the purpose of this example. Okay, and they're all going to be shareholders in a much enlarged group. Everyone happy with that? Okay. Why is it called an inversion? The reason it's referred to as an inversion is this is something that's been used by corporations in the US to escape very high rates of US corporation tax. What they do is, when they do their merger, they make sure that the entity that we're left with is a non-US resident entity, and it then falls outside US tax. And believe it or not, that is allowed under US rules, but they've introduced some rules which are intended to prevent that. But the idea is that the company doing the acquisition will be something that's outside the US. So in this example, Allergen is outside the US, Pfizer is in the US. So if Allergen acquires Pfizer, even though Pfizer is actually the bigger company, if Allergen acquires Pfizer, then we can have an entity that's non-US resident, right? Okay, subject to all those rules I said about before about permanent establishments and everything, but you can get basically into a non-US regime. So it was going to be, and for this purpose, of saying Pfizer Allergen, so PA, that's the new company. Now in reality, the way this would probably look is that you would have a company at the top and that would acquire the two companies. It would acquire Pfizer and it would acquire Allergen, and all the people who are shareholders here would get issued the shares in here in consideration for transferring their shares in here. Yeah, everyone see that? So the new company becomes a 100% owner of Pfizer, it becomes a 100% owner of Allergen, and everybody's a shareholder up there. Now, what the US rules said is it said that's absolutely fine, we'll allow that, and even though that means that Pfizer becomes a non-US resident company, we won't object to that, provided that you're not taking the mick, provided that really there is some substantial foreign presence in this company. And what you've got to get is you've got to still have where's the number gone? You've got to still have a 40% ownership by the foreign owners. That's what you've got to have at least, okay? And how do you work that out? You work that out based on the respective value of that and that, okay? And if that is worth more than 40% of the whole, then we're okay, aren't we? Everyone see that? Because the Allergen shareholders will own more than 40% of the combined group. They were the foreign shareholders. Provided they own more than 40% of that, no problem. This is an indication, though, of how different jurisdictions react to things that are changing in the real world. Because what the US did was they quickly introduced a new rule, and what this said is that that 40% rule was no longer enough. Instead, what they said was that not only would the foreign shareholders have to own at least 40% of this, But in looking at the 40% they own, you will disregard anything that reflects the value of a previous US inversion. A US inversion in the last 3 years. So if Allergen happens to have acquired any US companies in the last 3 years, we're chopping out the value of those and we're only looking at that value instead, what's left over. The value of these can't form part of that calculation. Now if the value of that goes from being 44 in our example to only 20, then all of a sudden the Allergen shareholders don't have 40% up here, do they? They get less than 40%. And that was the rule that was introduced in the US, and everybody knows it was intended to stop this deal going through, and it worked. So that's an example of how really the rules are being, where there are already attempts in the US to stop people doing this and taking companies outside the US tax net. And you could apply that to other jurisdictions as well. So yeah, go on.
So how does that help Pfizer though? Because that's still a US corporation, isn't it?
It is, yeah.
Yeah. In US.
Yeah.
So how does that save tax for Pfizer?
Again, it depends on the structuring that you're doing here, because ultimately you've got the entity is actually outside US tax rules, apart from the extent to which you've got a PE that's in the US. So what you've got is, I mean, it's going to get pretty complicated, but you're going to have a participation exemption, for example, so you can transfer dividends up. You can have way less profit attributable to Pfizer in the US because of transfer pricing agreements. So you can have you can have lots of IP in the top company, and that can be charging it to Pfizer. So you're back to that structuring really. I mean, you're right. It doesn't instantly take you outside the US tax net. You've then got to layer on things, planning around that in order to get to the holy grail of the profit being outside the US. But the point is, it opens the door to there being profit outside the US. That's really what it is. Yeah? Okay. Does that make sense? Everyone see what happened there? Everyone see what the US did there? Can you see why they did that? And the question here was, well, hang on, has that done anything anyway? Because don't we still have a US entity? Almost certainly you do. Almost certainly, however you structure it, you've got an entity that will be be managed and controlled, you would imagine, in the US, if not registered in the US. You've got the potential for it being completely non-US resident, but probably you've got something that's US resident, but you've then got the scope for limiting the taxable profit of that entity in the US, which you haven't got before. So that's really what that's about. Okay? And we'll have a little case study for you. Can I ask everybody to have a look at this? Can you all read that okay? If you just have a read through that while I just see where we are. Okay, just run through this then. You're the CFO in a UK company, congratulations. And basically what we've got is we've got a key supplier in Germany that's about to go bust. And the German company has significant losses and the balance sheet doesn't look that healthy. There it is. But what we want is we want to protect the relationship, so we're considering buying it. But the only problem is we've got several problems. The UK company has got subsidiaries. So there's UK Co, and it's got subsidiaries, that's the border, sorry, that are in Germany and the US. And they're profitable. The German company over here, our supplier, has got this French subsidiary. And the French subsidiary is actually a competitor, and we don't really want to acquire it. What are our thoughts there? What are the key tax considerations? What's the first choice we've got? What's the first choice we got?
Shares or assets.
Exactly, shares or assets. What do you reckon?
Well, there might be losses if you acquire the shares.
Yeah, okay. Yeah, good, a very good point. If we acquire the shares, the point here was we could be getting the benefit of the tax losses in the German company, couldn't we? Well, subject to what the rules say and what the rules say about the carry forward of those losses. There are normally strict rules about bringing forward losses of an acquired entity, and they can be ring-fenced against the trade of that acquired entity. But if you can make that trade profitable, then bringing forward those losses can be fine. Whether that's the same trade, whether under UK rules there's a change in the nature of the trade and a change in the ownership of the trade within the 6-year period, then there's a limitation on bringing forward losses. So there's all those sorts of things to worry about. But the point is, if you buy the shares, you may be able to use the losses of that German company, dead right. What's the other alternative? We're not buying the shares. What's the other alternative? Trade and assets. Why might that help here? Exactly, we don't want the French company. Those French. So I shouldn't be jingoistic with this audience, really. What we have is a German company that has assets that we want to buy, but we don't want to buy the French company or their assets. If we just buy the assets from the German company, then we can leave that structure sitting as it is, and we don't have to worry about our relationship with the French subsidiary. Yeah, any other thoughts? Well, the other things really are, where do we buy it? Because we could buy it under the German subsidiary, it might make sense. We could buy it in the UK, we'll have a lower rate of corporation tax in the UK. We could buy it under the US subsidiary. We could set up a special purpose vehicle to buy it if we buy the whole thing. The brought forward losses, I think, is the bigger tax point here. But really, your main considerations are going to be where you buy it, what that does for the effective tax rate of that company going forward, and whether the brought forward losses and the use of those brought forward losses in this context can be significant enough to mean that buying the shares actually outweighs buying the assets of the company. You've also got, if you buy the shares, what tax have we got? Stamp duty. What if we buy the assets? What tax have we got?
Depending on VAT.
We might have VAT, it's possible, and it depends on the assets. That's right. If we've got land in there, then we may have stamp duty land tax, we may have an additional rate, and then you have to look at the VAT considerations on it as well, because we will have a cross-border VAT supply. So we will have a VAT supply going cross-border, so we have to look at whether there's a reverse charge transaction on that, or can we get it within transfer of going concern. Okay, so they're the main things on that. Okay, just mention this because this again might be relevant to your choice about buying shares or assets. Lots of countries now have participation exemptions. Participation exemptions really is an exemption from dividends received from one company being paid into another company, and also an exemption on the sale by a company of shares they own. And the one thing I didn't cover in those examples is it's important to think about it from the point of view of the purchaser and the vendor. And by the way, I'll quickly go through these. We've got two slides here. One where you've got a company with an effective tax rate of 30%, and another where you've got an effective tax rate of 12.5%. I wonder which country they're thinking of there when they said 12.5%. I can't imagine which that is. I am actually Irish, by the way, so I can make any jokes about Ireland that I like. So you have, so you've got clearly a lower effective tax rate in the case of that, company. The valuation of the company goes up dramatically where you have the lower effective tax rate. You see where that changed? It's exactly the same numbers apart from that, 834 and 667 where you've got the higher tax rate. Why is there such a big difference? Well, the big difference is it multiplies out, because normally when you're valuing a company and when you're looking at the value of an enterprise, you're normally looking at the maintainable profits of that company and then trying to imagine how long you can maintain those maintainable profits, and you're paying the company a multiple of that. Now, some valuation methodology requires you to do that on a pre-tax basis, but frequently where you're looking at multinational transactions, then you will be looking at a post-tax base. You will be looking at the effective rate, because really you're trying to get back to the genuine value for the shareholder, and where that shareholder is another company, and that will be a factor in determining what that value is. So it's a big difference. So the effective tax rate, so remember when we're deciding where we buy that subsidiary, there or there or there, when we're looking at the price we're negotiating for it, bear in mind the vendor will be aware of that, they'll be aware of that change, and they'll be looking for that number instead of that number, and that's a point of negotiation then. And the other thing, this one I just touched on, if you look at it from the point of view of the vendor as well, that can actually help in negotiations when you're buying the company, can't it? Because remember I just mentioned participation exemption. If you're buying the shares, it may be that a sale for the vendor is tax-free. Whereas if you're buying trading assets, it may be that it's fully taxable in the vendor. So the position of the vendor could be very important. Stamp taxes don't apply for the vendor normally. They can apply if they've had an intergroup transfer before. So if they've transferred something intergroup using an exemption that applies for assets transferring intergroup, and then they sell it within a certain period of time, under UK law you would have a stamp duty charge, but don't worry about that. But basically it's the stamp position isn't really the concern of the vendor, but VAT is, and not losing liabilities or losing liabilities when you transfer the shares is going to be a significance for the vendor, and not losing them if you buy the trading assets is going to be a significant point for the vendor. And it's similar points here really, but it's in reverse because here we're looking at trading assets. And this is the less common option, but generally what you'd expect is the vendor's more likely under current international law and under current tax law in different countries, they're much more likely to have a tax charge on the sale of trading assets. Right, very quickly, we only have 5 minutes, so why don't you all have a quick look at this case study, have a read of that, and again, just want you to shout out in a couple of minutes some of the main considerations, some of your main thoughts, what questions you will ask your global tax advisory team and the purchaser when you meet. Just think about the answer to that and we'll see if we can jot something down for you. So just a couple of minutes, guys. Come and read it, okay? You're the CFO of a multinational group headquartered in the Netherlands. Hey, you're on. And a competitor has been trying to gain a footprint in Saudi Arabia for many years and has now approached you and the CEO regarding acquiring your Saudi subsidiary, focused on oil and gas consulting for $2 million US. Oh, way too cheap. So basically we've got a Dutch company here. It's got a Saudi subsidiary. And that is involved in oil and gas consulting. Okay. What are we going to say? What are we going to say to our tax advisory team and to the purchasers when we meet? Give you 1 minute. Okay, your time is up. Put down your pens. Stop writing now. Oh, no one is writing. So can anyone shout out any thoughts about this at all? What questions are we going to be asking? What do we want to get to the bottom of?
Participation exemption.
Fantastic. Okay, yeah, everyone agree with that? Do we have a participation exemption on the back row if we sell the shares? Yeah, I think we do actually, as far as I know. So, I mean, they operate differently. I mean, the UK one is called substantial shareholdings exemption. So you've got to own more than 10% of the shares and you've got to have held them more than a year. So it's pretty generous, to be honest. And I don't know how the Dutch one works, but I'm guessing it's quite generous as well. I mean, most of them are. So if we sell the shares, do we have participation exemption? Dead right. Good call. Anything else? Oops. Anything else? What's it say at the bottom?
You've got a claim that if you sell the shares, then you're divesting yourself of that level.
Yeah. So what's everyone think on that on a practical point?
If they find out about it, then if it's a share sale, then they're not going to reduce the price, or there might be a I can't think what word it is now.
Warranty indemnity. Yeah.
So you might lose the money anyway.
Yeah. Okay. It's tempting, isn't it, to think, well, if we flog them this company and don't tell them about this claim, fantastic. Not our problem then. Just keep quiet about it, whatever you do. And believe me, it happens all the time. The fact is, unless they are plain stupid, I've got to say, If it really is $2 million US is the price, then actually they may be playing stupid, because you often get deals at that level without any proper advice or any really decent advice. Their lawyers will be telling them to have very strong warranties and indemnities in the sale and purchase agreement, which will mean that when that comes out the woodwork, that would almost certainly be something that we'd be liable for, you would imagine. But I've seen dafter things in real life. I mean, you know, it's not the best business practice just to keep quiet about that. But you'd want to explore that, wouldn't you? You'd want to explore how likely it was to come out, and then you've got to decide whether that's something that you want to disclose, or whether it's just something you're going to be happy to cover in the warranties and indemnities. And if it does come up, then fine. What procedure will they go through when they're buying this? What's it called? Due diligence, yeah. So they'll have a team in. And due diligence procedures, by the way, they vary in vigour. Some of them you just get a questionnaire and you just send off the questionnaire, and all they're doing is trying to identify anything where they require a specific warranty in the sale and purchase agreement. And the only difference there is that a specific warranty normally isn't capped by a de minimis limit. So in other words, if it's a small claim, then you can still claim under the specific warranty, whereas under a general warranty, unless it's going over a certain level, you can't normally get it. That's normally the only difference, really. So you might want that, and they might want a specific, you might want to disclose it, and they might want a specific warranty. All you want to be sure is you don't want to get to the point where they're insisting on retaining some of the proceeds, which you can see. So some people will insist on a retention and an earn out, so a payment later on, depending on how everything goes. How can you get around that? Oh God, who put that there? I did. How can you get around that problem and definitely mean it isn't a problem for the purchaser? You do it as a trade and asset sale. So I think one thing is it trade and assets or is it shares? Okay.
Necessarily, you might not want to have that debt, intercompany debtor still owned. So, what's the implications of writing that on?
Very good. Yeah, I think that's right, because I mean, what you could do is you could sell the trade and assets out of the Saudi company, and then you could lend the money back up here if you wanted to do it that way. But you'll be in a slightly funny position. You'll have a whole load of cash sitting in the Saudi company. You might be able to dividend it up without there being any tax charge on doing that. I think that would give you distributable reserves that you could dividend up. But are you talking about the intercompany debt that's already there? Yeah, that's true. So if you sell trading assets, you're left with that intercompany debt, and you've got to work out what you do with that. Yeah, no, fair point. Well, we've run out of time, ladies and gentlemen, so I'm going to cut it there.